Hi everybody, it's Spencer Hakimian. Welcome back to another episode of What's Moving Your Money. On today's episode, we are going to be talking about the AI boom, just how much AI is currently helping the US economy, whether or not the US economy would be in recession right now without AI. Then we're also going to talk about some of the negative effects of AI, such as rising electricity prices and potentially even rising unemployment. So sit back tight, get ready, and I hope you guys enjoy. So ever since the beginning of 2023, we have had an AI boom as a country. This famously began with Nvidia's earnings report in February of 2023 that showed a massive beat. And at the time, if you recall, we were in a pretty substantial earnings recession and a pretty hefty bear market, particularly for tech. 2022 was the worst year for the US stock market since 2008, largely on the back of higher inflation, higher interest rates, and lower multiples, especially on growth stocks like tech. Then it all changed when in February of 2023, Nvidia reported earnings and it showed a massive beat. Now, this beat came from the fact that Nvidia supplies the chips that fuel the data centers that are required to store all this raw data that is necessary for LLMs, large language models like ChatGPT, like Grok, like Llama from Meta. All of these are powered by massive amounts of data that require the best chips available on Earth and a lot of electricity. We are talking crazy demand for electricity that we simply do not have on our grid, which is pushing electricity prices up substantially, particularly in states like New York, California, Georgia, Virginia, places that are heavily invested into AI already. But we're gonna get to that a little bit later on. I wanna talk today about whether or not we would be in recession right now, not even in the future, right now, if we hadn't been getting so many tailwinds from AI. Look, in the latest quarter GDP report, AI contributed more to net growth than consumer spending did. Think about that. Consumer spending is 67% of the overall economy. AI spending is roughly 6%. So consumer spending is 10 times bigger than AI is. Yet, AI contributed more to our net growth than consumer spending did. It is exploding. The tech investments that are being made into AI right now, literally a once in a generation cycle. The last time we saw anything somewhat like this was during the computer boom of the 1980s and 1990s. Now, one thing that we have to consider with all of this spending, and we're seeing it in earnings reports, is that the AI hyperscalers are really limited to a handful of companies, mostly in Silicon Valley and some in Seattle. This is not something that the broad tech industry is participating in. This is really limited to 5 or 6 companies and a few different niches that are benefiting all of this spending. So the gains are quite uneven. As an example, look at 2 companies that just 3 years ago had an identical business model: Snapchat and Meta. Facebook, Instagram, WhatsApp, all of the things that Mark Zuckerberg's company owns. A few years back, those companies, their revenues were like 99% correlated. They were ad companies. They went with the health of the economy. If businesses were doing well, if consumers were doing well, ad spend went up and those companies benefited. In this past quarter, obviously the consumer is weakening right now, but at the same time, AI is growing. So what did we get? We got Snapchat and Meta report pretty bad ad revenue growth for the year, but the only difference was Meta has a pretty large AI business now, and that exploded in growth. Usage exploded. Integration into other apps exploded. Efficiency in ad recovery exploded through all of this. And what ended up happening? Meta reported earnings that just because of the AI categories beat, and Meta stock rose by over 10%. The same industry, Snapchat, because it only has exposure to ad, it does not have any AI exposure, fell nearly 20% after its earnings. The only difference between these two companies is that Meta now has a pretty significant AI investment section that Snapchat does not have. And it gets to my overall point. Right now, our economy is so dependent on all of this AI spending growth. And thank God it happened now, because we have a weakening housing market, we have a weakening consumer, we have elevated interest rate, we have very high trade uncertainty, we have exports that are falling, we have rising inflation on our imports, we have food inflation that's rising, right? We have so many headwinds in our economy right now. The only thing right now that is significantly helping to the upside is all of this AI CapEx spending. Now, we have to talk how sustainable this is. Because as you guys all know, at a point, the tech companies are going to reach a point of diminishing returns. They will reach a point where it is no longer logical to keep investing at a 40% growth rate into AI products, tech, chips, data centers, LLMs, research, everything, engineers, all of the above. So that point is, if we want to use the computer revolution as a good metric, likely about 3 to 4 years away, which is a good sign if you ask me, because we can hopefully ride this AI wave. Hopefully, I stress hopefully, I don't know if it'll happen, but we can ride this AI cycle through this soft patch in this overall economy such that we can avoid an overall recession. I think largely what the stock market is pricing is, don't forget, the stock market has a way higher exposure to AI, particularly the NASDAQ, than the overall economy, right? 35% of the NASDAQ may just be AI spending, right? It may even be higher, but the average town in Nevada, 0%, maybe 1% is correlated to AI spending. So there is a chance that in the coming quarters, the coming years, we might get a stock market that is performing exceptionally well, particularly the tech sector, while at the same time, we are getting an economy that is not doing so well. One great example of this, in the late 90s and even up until the early 2000s, in the beginning, tech was exploding, but the economy as a whole was softening. Ultimately, what ends up happening is that tech is not bigger than the entire economy, and ultimately, as the entire economy goes, technology stocks, which are a risk asset just like anything else, will in the long run follow, right? In the long run, if you looked at a 15-20 year cycle, the NASDAQ didn't really outperform the S&P or the economy overall. It was just in the short run that it did, and it can mask some of the problem. But the final thing I think we should talk about here on today's podcast is electricity prices, and also let's talk about the unemployment rate as it stems from AI. I think it's very interesting. Usually when we get a investment boom in this country, whether it's AI, whether it's computers, whether it was railroads before that, whatever it was fantastic for the overall society, because investments went up, which meant jobs went up, which meant wages went up, which meant incomes went up, which meant spending went up, which meant asset prices went up, and it was a self-fulfilling cycle to the upside. Now, the immediate effect of AI, because we have to place massive investments first before we get products, right? The main AI product that humans are using right now are LLM, right? But we can envision a world where almost everything in our daily life is involved with AI, but that is going to take investment. In the interim, the only tangible effect that most people are getting from AI is that electricity prices are skyrocketing. Here in New York, electricity prices are up over 35% year over year. In Georgia, they're up over 30%. In California, in some areas, they're up 40%. And in Northern Virginia, where the majority of the data centers in this country are, the high performing ones, there are some parts of Northern Virginia where electricity prices are up 50%. Now, if the average person, the only effect they're gonna get from AI for the next 3 or 4 years is that they're gonna get rising electricity prices and rising inflation prices due to cost of living, this might be something that in the short run is, believe it or not, a net negative for not only society, but for the economy specifically, which is so strange to think about, but it is completely possible, right? The only tangible thing that we are getting from AI at the moment outside of LLMs is spiking electricity price. Now, at the same time, if one of the main goals of AI is to make companies more efficient and more productive. And it is to eliminate those repetitive, mundane, very, easily switchable jobs like bookkeeping, like tagging inventory, like accounting, like inventory management, whatever it might be. If that gets offshored to AI, do we actually have a scenario where corporate profit margins are rising due to this gain in productivity, which is great for stock prices, but we get rising unemployment because companies can lay off employees because they can replace 10 employees with one AI model to do its job? And that would actually be bad for stock prices, because if unemployment goes up, then spending is going to go down, and how's the economy going to perform? So AI is so interesting, and I want you guys to comment, what do you think AI will ultimately lead to? Because I can see this going so many ways. I can see this being an incredible benefit for society, or I can see this being an incredible harm for society. In the short term, I can see AI being just inflationary, but in the long term, I can see it being massively deflationary. There are so many ways where this puzzle can go, and that's what makes markets so interesting. We really don't know. Every day is a surprise. Every day we have to learn more. So I want you guys to comment what you guys are all seeing as it relates to AI, and I hope you guys like this episode, and I'll see you guys again on Friday.